Welcome back to the Daily Crypto Deep Dive. Today we're going somewhere the headlines barely touch. The quiet revolution that's transforming Wall Street from the inside out. It isn't happening on Reddit forums or in Telegram groups. It's happening in boardrooms, under NDA, between some of the biggest banks, asset managers, and tech firms in the world. The name for it sounds boring. Tokenization. But don't let that fool you. This isn't a side project or a speculative experiment. It's the scaffolding for a new financial system. One that could make the dollar itself programmable, and every stock, bond, and property in America tradable 24/7, just like crypto. It's happening right now, and most people have no idea. The story begins with a paradox. For decades, the United States has had the most powerful financial markets in the world, but also some of the slowest. Trades settle in days, not seconds. Bonds worth trillions still rely on spreadsheets and PDFs. Real estate deals take months to close. And while the stock market looks high-tech on the surface, behind the curtain, it runs on infrastructure built in the 1980s. In other words, the pipes of American finance are still analog, and that's exactly what's being rebuilt on blockchain. When BlackRock CEO Larry Fink stood on stage earlier this year and said, "The next generation for markets will be the tokenization of securities," most people brushed it off as corporate PR. But behind those words sits an entire strategy, one that could bring Wall Street and blockchain into full alignment. So let's break this down. What does tokenization really mean? Why does it matter? And how does it quietly pull crypto out of the shadows and into the center of the global economy? At its core, tokenization means taking a real-world asset, a bond, a share of stock, a mortgage, a fund, and representing it digitally on a blockchain. The token doesn't just symbolize ownership, it is ownership. It carries the same legal rights, the same cash flows, the same obligations. But instead of being tracked by custodians and middlemen, it lives on an immutable ledger. That might sound like a technical shift, but its implications are monumental. Because the second assets become digital, they inherit all the properties of crypto. Instant settlement, global liquidity, transparent accounting, and fractional ownership. Suddenly, a $10 million bond can be divided into 1,000 pieces. A Manhattan apartment can be sold in shares. Liquidity becomes democratized. And this isn't theory, it's already happening. JPMorgan has quietly moved over $500 billion in tokenized assets through its private blockchain, Onyx. BlackRock recently launched a tokenized treasury fund on Ethereum. Franklin Templeton did the same, making it possible for investors to buy pieces of U.S. government debt in their crypto wallets. Even the U.S. Treasury has been exploring blockchain settlement for short-term bills. In short, the traditional finance world isn't fighting crypto anymore, it's absorbing it. But to understand how deep this goes, you have to step back to the logic behind it. Banks and asset managers aren't chasing ideology, they're chasing efficiency. Tokenization eliminates layers of cost. Custodians, clearinghouses, reconciliation teams. When every asset and transaction sits on a shared ledger, there's no need to reconcile books between institutions. The ledger becomes the truth. That's why the biggest firms in America are experimenting with private versions of public blockchains. Systems that look and function like Ethereum or Solana, but are locked down and compliant with securities law. They call it enterprise blockchain, but the philosophy is the same: code as settlement. If that sounds familiar, it's because crypto has been building this infrastructure for years. Only now, Wall Street is adopting it under new branding. The irony is impossible to miss. The same institutions that dismissed Bitcoin as a bubble are now borrowing its architecture to modernize their own empire. They won't admit it publicly, but every tokenized fund, every blockchain settlement pilot, every digital ledger experiment is an unspoken acknowledgement that crypto solved something the old system couldn't. Let's dig deeper into the numbers. According to Boston Consulting Group, the global value of tokenized real-world assets could reach $16 trillion by 2030. The World Economic Forum estimates up to 10% of global GDP could be represented on-chain by then. That's not a fringe prediction. That's an entire asset class being rebuilt. And the United States, despite its cautious regulators, is leading the charge. In 2023, the Federal Reserve approved the first tokenized deposit trials. Banks issuing digital deposits backed one-to-one with dollars, but running on blockchain rails. This is separate from central bank digital currencies. It's the private sector's version of digital cash. Imagine your paycheck landing instantly, your mortgage payment clearing in seconds, your investments updating in real time. That's the efficiency tokenization brings. But it also brings a new kind of surveillance and control if misused. Because once assets become programmable, they can be governed by code. Transfers can be restricted, spending can be automated, taxation can be instant. The same technology that makes finance frictionless can make it fully visible. That's why tokenization sits on a knife's edge. It can either free markets or lock them tighter than ever. For investors, the short-term story is opportunity. Tokenization opens up asset classes once reserved for the elite. You won't need a private banker to buy part of a BlackRock fund. You'll need an app. You won't have to save $50,000 to invest in property. You could own a piece of a building for $50. Fractional finance turns exclusivity into liquidity. But beneath the optimism, something deeper is happening. The infrastructure of the US economy is being rebuilt to make everything interoperable. Stocks, bonds, real estate, commodities, carbon credits, all tradable under the same digital standard. That means the line between Wall Street and crypto will disappear. Now here's the twist. This isn't happening instead of crypto. It's happening because of it. Every step Wall Street takes toward blockchain legitimizes the technology that underpins Bitcoin and Ethereum. The same ledgers once dismissed as unregulated gambling are now the backbone of trillion-dollar modernization plans. The overlap is widening. You can already see Ethereum being used as a settlement layer for real-world assets. Tokenized US Treasury funds run on public smart contracts. Stablecoins handle billions in daily trade flows between institutions. The same rails that move DeFi liquidity are now moving bonds. The market isn't fragmenting, it's converging. And that convergence creates both opportunity and danger. Because if banks control the infrastructure, they control the rules. Tokenized finance could replicate the old system's inequalities in digital form. Programmable, enforceable, permanent. That's the dystopian version. The alternative is a hybrid model, where decentralized networks like Ethereum remain the neutral backbone, and regulators oversee compliance at the edges, not the core. That's the balance the next decade will test, whether tokenization becomes a tool for efficiency or a mechanism for control. At this point, let's pause for a quick reminder about something that doesn't change no matter how the financial system evolves: security. Because when everything is digital, custody becomes everything. That's why today's episode is sponsored by Ledger, the world's most trusted hardware wallet. In a world where assets are becoming tokenized and programmable, true ownership means having your keys offline, in your hands, where no government or institution can touch them. Link in the description. Now, back to the story. To understand how big this is, look at who's building it. BlackRock, JPMorgan, Citi, Franklin Templeton, BNY Mellon, and Fidelity. All are running blockchain pilots or live tokenized funds. The total capital under management among those firms exceeds $70 trillion. If even a fraction of that migrates on-chain, the crypto industry as we know it will transform overnight. That's why the smartest crypto investors aren't waiting for regulation to catch up. They're front-running the tokenization wave by positioning in the infrastructure layer. The networks, oracles, and interoperability projects that will connect private blockchains to public ones. Chainlink, for example, is already powering tokenized asset feeds for several financial institutions. Projects like Polymesh, Centrifuge, and Ondo Finance are building compliance frameworks that let banks use blockchain without violating securities law. It's no longer crypto versus Wall Street. It's crypto as Wall Street's next operating system. Let's visualize this. Imagine every share of Apple, every treasury bond, every mortgage-backed security as a token. Each moving across ledgers in real time, programmable, divisible, tradable globally. No market open or close. No 3-day settlement. No intermediary risk. Capital flows like data. That's the world Wall Street is racing toward. But here's the part they don't like to talk about. Once you digitize assets, you make them portable. And once they're portable, you make them competitive. If a tokenized bond on Ethereum yields 5% and a government bond yields 3%, capital moves. instantly. Tokenization makes capital mercilessly efficient. That efficiency will force governments to compete for trust again. And that's where Bitcoin re-enters the picture. Not as competition, but as reference. Because when money and markets become software, the question isn't what's the yield, it's who controls the code. Bitcoin remains the only monetary asset with no issuer, no policy, no off switch. It's the control group in this great experiment. The longer tokenization expands, the more valuable Bitcoin's neutrality becomes. There's another layer to this: real estate. The US property market is one of the largest untapped opportunities for tokenization. From commercial skyscrapers to suburban rental homes, tokenized real estate funds are already launching quietly, giving global investors exposure to American property without a middleman. Soon, your house deed could live on-chain, your rent could be paid in stablecoins, your mortgage rate could adjust automatically through a smart contract. It sounds futuristic, but several pilot projects in Texas, Florida, and New York are already doing this. Tokenized ownership turns homes into liquid assets, which could stabilize markets or amplify speculation, depending on who wields the tools. And that's the paradox of tokenization. It's neither good nor bad. It's a mirror. It amplifies whatever incentives dominate the system behind it. If the goal is inclusion, tokenization can unlock global access to wealth creation. If the goal is control, it can lock that wealth behind code-based gates. The technology itself is neutral. The outcomes are political. In some ways, this is the Web3 dream playing out in disguise. The financial layer of the internet is being built not by startups, but by incumbents adapting. And even if they call it digital assets instead of crypto, the underlying architecture is ours. Public ledgers inspired it. Smart contracts made it possible. So where does that leave the everyday investor? It leaves you early, but not for long. Within 5 years, you won't log into a brokerage account. You'll open a wallet. Your 401k will hold tokenized funds. Your dividends will stream to you in real time. And you'll never think of blockchain again. It'll just be finance. The transformation is that deep. And the most fascinating part is that it's bipartisan. Republicans see tokenization as innovation. Democrats see it as modernization. It's one of the few financial revolutions in history with near universal alignment, because efficiency sells to everyone. Still, revolutions have winners and losers. The intermediaries who make money from inefficiency, custodians, clearinghouses, and certain middle-tier banks, will either adapt or vanish. Tokenization compresses the value chain. In a world where code settles instantly, the old toll booths no longer matter. That's why we're seeing a quiet scramble among legacy firms to reinvent themselves before it's too late. They know that when settlement becomes software, only those who own the rails survive. And the rails are blockchain. The public won't realize how profound this is until it's complete. It won't be a flashy moment like the launch of Bitcoin or the NFT boom. It'll happen gradually, transaction by transaction, fund by fund. Then one day you'll look around and realize that everything you own, your savings, your investments, your debts, lives on a blockchain. That's when tokenization stops being a headline and becomes reality. The US economy isn't replacing crypto, it's evolving into it. The lines are blurring, the walls are falling, and the software that started with a pseudonymous white paper in 2008 is now rewriting the foundation of global finance. So when you hear tokenization, don't think buzzword, think infrastructure. This is the merge between the old world and the new. It's how the next century of money will be built. Drop your thoughts in the comments, follow the podcast, leave that 5-star rating. And as always, we will see you at the top.